Well, hello everyone. My name is Mark Bramridge. I'm Director General of the Enterprise Investment Scheme Association. As you hopefully know, we are running a series of webinars this week, every day at 10 o'clock, looking at various issues at the EIS and the SEIS sector. And Tuesday's one will be about fees and exits. And we've just done a brilliant one this morning around kind of resetting the economy and looking back on 2020 and looking forward to 2021. Allied to those webinars, we wanted to run a series of very short, very quick-fire videos about how to help financial planners, accountants, financial advisors at this time. Obviously, bearing in mind it's a tax year end, we know you're very busy. So we just want to give you some ideas, some thoughts about what you might want to think about in this sector. And that's very much what we're going to do today. One of our sponsors of our webinars from Vala Capital, Debbie Mahanta. Debbie, hello. Do you want to introduce yourself?
Hi there, Mark. My name's Debbie Mahanta. I work as a business development manager at Vala Capital. I'm actually a financial planner by trade, which makes me a little bit different for some of my colleagues. And I've also worked offshore in banking in Switzerland. So I've dealt with advising UK clients that have offshore accounts as well. And so I wanted to touch on really some of the opportunities that lie for those clients in relation to business investment relief. I've been working with Vala now just for a few months, but we're relatively new in EIS, but very much looking forward to growing over the next few years.
So I guess new to EIS, but not new to early stage investing is the other point to make. And also, obviously, it's great to have an expert. As I say, you were a financial planner, you have all the qualifications, and like myself, I'm sure you still keep them up and keep them relevant. So ideal person to have on. Obviously, we won't be touching on financial advice or tax advice itself. That's not our role. That's not our remit. That's up to you guys and girls out there. I was just trying to give you some thoughts and ideas behind all this stuff. So Debbie and I were just talking off air a minute ago, and we thought one of the best things we could talk about, because it's very under talked about, is about business investment relief. So Debbie, do you want to give us a quick overview of what business investment relief is, how it works, how it's allied, and how it works with BIS? Give us the overview, please.
So business investment relief was actually introduced back in 2012, which, given we've just entered 2021, is quite a while ago now, and it's still relatively underused in financial planning. I think A, because people don't necessarily know about it, and B, because I think in the initial phases of it, I think people were worried about breaching the rules because the actual mechanisms of it can be quite difficult to achieve. But I think over the years, certainly when it comes to EIS investment, a lot of the managers have taken time to make sure that the mechanisms are in place to make sure those rules aren't breached. And I'll go into that in a bit more detail. What business investment relief allows a client to do is, if they have offshore funds in places like the Channel Islands, Switzerland, but it can be anywhere, and they're a UK resident non-domiciled person, a lot of those res non-doms, as we like to call them, pay tax on what's called the remittance basis. And that means that only pay tax on funds they remit to the UK if they contain income gains or capital gains. The issue a lot of people have with what they hold offshore is that often they don't know whether their funds are often mixed, which means they're clean capital and income gains, or capital and capital gains. And so actually doing an exercise to figure out what the pure capital was versus the income versus the gains is actually very complicated. And as tax accountants will know, it can be quite lengthy, and trying to figure that out with the bank accounts involved is actually quite lengthy and expensive. And so a client will sort of say, well, I want to figure out this, and then once they get the sort of estimate of what that means, it's quite often not very sort of cost effective for them to find out. What business investment relief allows you to do is, if a client brings money into the UK and then invests in a business investment relief qualifying investment, and in this context, obviously we're talking about EIS, which makes, we know that all EIS does qualify for BIR. Other unquoted shares do also, but we're not going to cover that today. It just means that any offshore funds, as long as they're invested into qualifying assets, it doesn't matter whether they're clean capital, capital and income, or capital and capital gain. And so if someone does have a mixed pool of offshore assets, it just means that it's an easy mechanism to get money into the UK and get it, make an EIS investment, which a client was possibly looking to do anyway with UK funds, but instead they're utilising some offshore funds which may be held in cash, either in a very low interest bearing or a non-interest bearing account, and in some extreme cases, a negative interest bearing account. So with funds that they've sort of just earmarked as, well, they're offshore, I'll use them when I'm offshore, I can't really do much with them in the UK. I think if clients knew there was an option for them to use them in the UK, then this mechanism allows them, and business investment relief allows them, to make good use of their funds. And this isn't a relief that excludes the existing reliefs. So if a client, for example, is a res non-dom, and a lot of clients I've dealt with in the past are quite high earners in the UK and are looking to make EIS investments for income tax relief purposes and or CGT deferral purposes, it means that using this offshore money, which is, as I said, generally in cash or in low interest bearing accounts, not having the issue of having to segregate what's clean versus what's not, is quite advantageous. Just going into the sort of more intricate detail, the thing that, as I said before, gets people a bit nervous about whether this will qualify, and that there's only a 45-day window in which you can transfer from the money hitting the UK to being invested into qualifying assets. It needs to be done within 45 days in order for it to qualify. And breaching that 45-day rule would be quite catastrophic in terms of creating a tax liability, then having to calculate what that tax liability is. And it can be easily avoided by having, as I said, admin mechanisms in place which ensure that that won't happen. And the way you would do that really with any sort of EIS investment was to ensure that the EIS manager that you're dealing with, or if it's a single company EIS, there's a mechanism to transfer the money to an offshore custodian, which is held there at the point of making the application, and then the money is only transferred into the UK when the shares are about to be allocated. And that can all be done relatively quickly. The actual offshore account to onshore account to a share purchase can be done within a matter of less than a working week. But the reality is you don't want to transfer to the UK awaiting for a transaction to happen, and then for whatever reason the transaction gets delayed, for it then not to be invested in time. Because what you'd then have to do, or what the manager would have to do, is send the money from onshore to offshore again to make sure the rules weren't breached, and then get ready again to send them over. So I think managers are quite used to now only transferring assets to the UK when they know they're ready to make that share allocation to the client. And in terms of share allocation, it works exactly as other EIS investment works, where you're still going to put that on your tax return, that yes, it qualifies for income tax relief, yes, it qualifies for CGT deferral if applicable, but it also qualifies for business investment relief. And so HMRC can see there's an admin trail of the fact that you've remitted funds into the UK, but that doesn't trigger a tax charge because it has gone into qualifying shares. So that's kind of sort of what happens when you start your investment. And as I said, as a manager, the manager will know to only remit funds into the UK when they're ready to invest in various companies. And like Vala, other managers as well, we won't make all of your investments in one go. Because you'll be invested in a portfolio of companies, we'll make sure you still get a regular portfolio, which is between 6 and 10 companies for the Vala EIS, for example, which other managers will also do, which will also be a portfolio approach. But we'll only transfer when we're ready to do deals 1 to 10 and make sure we don't breach those 45-day rules for any of those up to 10 investments. The other advantage of business investment relief is when it comes to the other side of actually coming to the end of your investment, again, it's the manager's responsibility to make sure those when you are liquidating those assets, they can be transferred offshore again within 45 days. One of the options the client has is to keep it's once they've transferred all of the original investment amount back offshore, they can actually keep any of the tax-free gains in the UK. So that's essentially, yes, it's had a delayed approach or a delayed effect of being in the EIS investment, and fingers crossed, all being well and good, there'll be a gain at the end of it, and then that gain can be kept in the UK. And again, there's no additional paperwork because it's been declared at the outset. It was invested into BIR qualifying assets. On the back end of it, any gains on those assets can be kept in the UK, but the original capital in every case does have to be sent back offshore. Yep. Or the other alternative is, if obviously if the client's happy with the way their investments have gone, they may wish to continue to invest in BIR qualifying assets. So that's another option. It's just to summarize, it's a mechanism to utilize funds that are offshore that may be probably performing sort of less than optimally, and really, especially if the client's looking to stay in the UK for a longer term. I think the knowledge that they're in sort of entrepreneurial businesses, which you'd hope the advisor would have established that that's quite a priority for the client anyway. It's kind of, why would you use UK funds for this, which might be used for, say, pension planning, other investments, where if you actually utilize some of your offshore accounts, they'll be best placed to utilize both BIR and your usual tax relief. So I think it's an interesting way of combining every tax relief that's possible. And like I said, I think because of that 45-day rule, people have shied away a little bit of feeling it's a bit too complicated. But I think once the admin sort of processes are in place, it's actually relatively easy for the administrators and the managers to get this right.
Yeah, I think you've done a great summary there and chucked a whole load of information out, which has been brilliant. just to kind of play that back to you, so I think I understand. So yeah, you're right. You have an offshore investor, or perhaps an UK investor who's got offshore funds. They want to bring those funds to the UK. Obviously, if they do that, they'll be hit by a remittance charge, no doubt. So obviously, it makes it very difficult to get funds offshore into the UK. We all know that. So this is a way, business investment relief is a way, and I think it's important to say it is a government relief. It's a government-backed scheme. It's not a loophole or a tax dodge or anything like that. It is a government relief. I know, talking to Treasury, you mentioned it started in 2012. We spoke to them, I think, in 2014, and they were disappointed how much or how little money had come in from offshore via the business investment relief scheme. So they're really keen for this scheme to be more used and be more fully adopted in the UK. So you get your money offshore into the UK. You talked about the 45-day kind of admin process, but that is an admin process. It's just a domino. You need to knock one domino over to get the other one kind of in train and in line. And then the money's here, and then obviously, hopefully, the company does really well, does fantastically, and those gains, they can then stay here, albeit the original capital has to go back to where it came from. Yeah. And obviously, you still also get, so it's a supercharged investment because you get that business investment relief, so you keep those gains here. Yeah, but you still get the all EIS tax release, all the 5 different tax release through EIS at the same time. So as I say, it's kind of a supercharged EIS, BIR. If I can think of another acronym, I will do. But, there's a whole lot of acronyms and reliefs that could be involved here. So yeah, as you say, I think it's a massively underutilized scheme. I'm really glad that you brought it up.
And I think especially with Brexit now having happened, I think obviously clients are going to be looking at interesting ways to invest in the UK economy and invest in entrepreneurship. So it's part of the, this isn't a standalone conversation. This is part of the overall conversations you're having with your clients in terms of what their goals are. And then I think it's really important as well for UK advisors to be aware of what assets are around outside of the UK, and whether, fair enough, if they've got offshore property which is illiquid, then but at least as part of the fact finding process, I think it's very important to know and have knowledge of what is around offshore, and if there are other sort of property owners in an offshore property which may have estate planning issues, etc. There are going to be liquidity events which advisors in the UK should be aware of, and I suppose the other separate to EIS, the other conversation which may lead that may then sort of be derived out of that conversation is what their will planning is for offshore assets, because I think from a non-UK perspective that can often be overlooked, and sort of cross-border wills are certainly through what I do with STEP is very much something that clients are looking to do more comprehensively, generally because they've seen people that have gone through that not done a comprehensive job, and I think all UK planners should really be looking to have a comprehensive overview of what their clients' worldwide assets are.
Yeah, absolutely. I think the COVID has brought to the fore more, perhaps again, unfortunately, inheritance tax, things you need to think about at the time. And I know obviously tax implication and look at inheritance tax rules and put some proposals out there. We'll see what happens with the budget in March, but lots of things that could be happening at that point. But Debbie, that's been a really great run through of business investment relief and what it is and how it works. As I say, I think it's a massively underused investment relief, so it's well worth looking at if you have got offshore clients with funds offshore. As I say, UK investors with offshore funds as well. It's a great way of trying to get some of that money back into the UK if that's what they're looking to do. So Debbie, I know you want to talk about suitability as well, but that feels like that's a whole new separate half an hour chat, so we'll perhaps save that for another time. But Debbie, thank you very much for filling us in on business investment relief, and we'll see you soon, and we'll see Vala on our webinars this week as well.
Great, thanks very much, Mark.
Thanks a lot. Take care, everybody.